I'm waiting for the clicker, but that was an incredible story, and I am going to do my best to, thank you, tell a story with data today about what is happening in the economy, what we saw in the travel sector in 2023, and what we see coming in 2024. So my name is Matt Varabkanich. I'm a senior associate covering the travel industry at Cleveland Research Company. I'm excited to be back at Houde and spend some time today reviewing the top themes in our work. I'll spend the next 20 minutes hitting you with a lot of information. Then we'll have a Q&A. If there's one slide from the presentation to take a picture of, I suggest that it's this one. I would be happy to send anyone the deck individually afterwards, and I'm sure it'll be available through Houde afterwards as well. So we'll start by reviewing the top macro trends in our work. From there, review what we saw develop in 23, discuss some of the macro themes that we see likely as to influence travel spending this year, and conclude with our forecasts for the year. So let's start by setting the macro stage. I think everyone here is familiar with the headlines around the health of the US economy. The big question has been, are we going into a recession? I know personally from the dinner table over both Thanksgiving and Christmas that there are varying degrees of opinion on this topic from several crazy uncles. But at the end of the day, the global economic health, it looks strong. The global economy continued to grow at a solid pace in the third quarter, driven largely by the US economy. In the US, GDP expanded about 5%, which was about a point above expectations in the fastest pace since 2021. This was driven primarily by consumer spending, which is the orange shaded color on this chart. Now, we're not economists, but what the expectation does look like for this year is that consumer spend is likely to grow, or is slow, which we'll hit on in a little bit. Headline unemployment numbers look strong, but on the very bottom right there, you can see a little bit of an uptick. And the near-term metrics do suggest some weakening. This is supported by two kind of notable leading indicators. The first on the left is job openings in blue, which have tailed off recently. And second on the right is showing overall unemployment versus California unemployment, which is the blue color on the right side. We're seeing a re-acceleration of unemployment in California, which tends to foreshadow broader employment softness and has led overall US unemployment in the past four recessions. So why the softer trend lines in employment? I think part of it comes back to inflation, which is not a novel factor. The headlines would suggest that inflation is coming down, which it is. But I think it's also important to view inflation through the lens of a consumer, which is basically to say, what am I paying today versus a few years ago? And that's what this shows, kind of looking at 4-year stacked inflation, essentially today's prices versus 19. We're still around 20%, and that hasn't really slowed much, and it compares to the historical full-year average of about 7. So you hear all this talk about the Fed needing to bring rates down, and this supports that despite the headlines. So then the question is, why are we not in a recession already? First, the consumer still has a decent backstop on their savings. Our consumer survey work suggests that savings rates haven't really come down a ton, and that household stress around expenses has been fairly steady over the last 18 months. In addition, a decent swath of consumers were able to get into their homes ahead of house price appreciation, and also saw their assets increase along with the stock market in 2020 and 2021. But on the flip side, the metric that we've been watching kind of closely has been consumer credit. The chart on the left shows credit balances for middle and low income consumers are above 2019 levels, and on the right shows total household credit balances are rising above pre-pandemic levels and above 2008 levels. So key takeaways to start. Coin flip on recession. We don't but we don't think the consumer is looking any healthier 3 to 6 months from now. Whether or not we are in a recession officially doesn't really matter to our team and probably to most of you in this room, because at the end of the day, a weaker consumer is just not as good for travel demand. We think multi-year inflation, interest rates, and stagnant wages, real wage growth are showing up in personal spend decisions. And lastly, credit could be a piece that drives a broader slowing. So with the state of the economy established, let's turn our attention to some key trends that shaped 2023. Big picture, travel is back. We're an increasingly migratory species. Travel's a secular share winner over time. There's more people traveling at longer lengths of stays. The middle class is growing. People are more flexible on remote work. Before the pandemic, the travel industry was growing mid-single digits, and it likely reverts back to that over the next couple years, with Asia probably as the biggest tailwind. Looking at the recovery rates versus that time across each of these major verticals, the vast majority of gains versus pre-COVID has been driven by pricing. We're going to spend some time, we'll hit on a few areas, but most of the discussion will be centered around the US hotel market. So zooming in on the US, in 2023, hotel industry RevPAR is likely to grow 5% year over year, still just waiting on the December data. But that'll put it 13% above 2019 levels, with demand still down a couple points and ADR up around 18%, which, as we saw earlier, is basically in line with the 4-year stack inflation metric. So demand is still lower, and pricing has basically matched inflation. For context, on the right side, this compares to the long-term growth average of about 3%. This was about, the 5% growth was about a point below expectations heading into the year based on our work, which was primarily due to softer than expected growth emerging through the summer. We run a monthly survey of about 50 revenue managers across the US. In that survey, a net 30% of respondents beat their first quarter forecast, and about a net 20% reported softer than expected growth in each April through December. So RevPAR up 5, a touch light of initial expectations. What caused that? First, we need to understand what happened with demand. U.S. hotel demand, or simply heads in beds, was up about 1% year over year through November, and is likely to finish the full year there. And if we compare 23, the dotted line, to 2019, the gray line, the deficit was really evident through the summer, May through August. But demand looked a lot different kind of under the hood by day of week, location, and segment. Broadly, weekday occupancy was flat, and weekend was down in the second half of the year. By location, 3 of the top 6 growers were in the Northeast: New York, New Jersey, Massachusetts. Next on the list was Nevada, speaks to Vegas, and likely increased convention demand. Where on the flip side, the worst states from a year-on-year demand growth standpoint were leisure-driven states: Maine, Vermont, Idaho, Oregon, Alaska. And not surprisingly, if you look at these relative to 2019, the leisure-driven states are still up the most. So that's more clearly explained here, which demonstrates that year-over-year demand growth was only evident in urban markets in the back half of 23, while interstate, resort, and small-town hotels saw the biggest declines. So we looked at demand by week, day, by location. Now let's look more into demand segmentation. Broadly, this is indexing each demand segment relative to pre-COVID levels. Leisure, we think, was down a handful of points year over year in 23, but was still the strongest versus 19. Group, likely mid-single digits off of 19, but got back there in October, which was great to see. And corporate, we believe, is still kind of low double digits in total off of 19 levels, with the shortfall really being from kind of large enterprises. So how does that compare to other travel sectors? In contrast to the 1% growth in the hotel industry, US short-term rental demand, so think Airbnb, Vrbo, is expected to finish 23 up high single digits year over year. US air travel demand grew about 13% year over year, and cruise demand grew about 60%. Now, these full year growth numbers are distorted and don't really tell the full story for two reasons. First, even though we're 4 years away, it's important to understand how they look versus pre-COVID. And second, the first quarter of this past year had abnormally high growth rates because we were comping over an easier period. So to frame that up, here we're looking at monthly demand indexed to 19 levels across those segments. And through 2023, which is the gray shaded area, each segment of travel basically kind of held the line versus where it entered the year, with the exception of cruise, which had the most meaningful deficit to make up. So sitting here today, hotel, we saw the vast differences in year-on-year growth, but hotel, cruise, and air travel demand are all plus or minus a few points versus a few years ago. And short-term rental demand is nearly 30 points ahead. I thought it may be helpful to put this in context too, relative to the most common areas where people are spending on goods. So US hotel industry demand outpaced year-over-year growth for places like Walmart, Target, so mass retail, club retailers like Costco, and grocery stores. The only retail channel that outperformed was dollar stores, which again, I think comes Dollar Tree, Dollar General, which comes back to, I think, the lower income and trade down theme. So this is our estimation of where we are today. What the solid black bar is what you can expect to pay, and the shaded bar is how much more of it is happening. So with the state of the US economy and the 23 review established, I wanted to talk through a few more travel-specific macro trends shaping the year. First, consumers are allocating more spend towards services and away from goods. In the past, nearly 70% of consumer spend went towards services, so recreation, healthcare, food, most importantly, travel. And the pre-COVID trend was that mix was increasing. Obviously, COVID took away the ability to do a lot of those things, so goods became a larger share of spending habits. That inflected entering 2023, and while the spend on services is still 2 points lower than 2019, that doesn't seem like a lot, but it represents a few $100 billion of annual consumer spend. So compared to roughly 2 years ago, accommodations have gained, and food service have gained back about half a point. When we think about how that translates into travel, I think a good example is one of our recent consumer surveys, which shows an increase in the amount of consumers planning to further change their spending habits if prices continue to rise, but not for travel, at least for the high income brackets. So in that same sample of consumers who plan to reduce spend if prices continue to go up, when we break that down by income level, over half of high income consumers and about a quarter of middle income consumers plan to spend more on travel over the next 6 to 12 months than discretionary goods. And about half of middle and high end consumers plan to spend a higher percentage of their wallet today versus a year ago on travel. So that's supportive of continued share gain for travel. The high versus low income dynamic, I think, is evident in the lodging industry data as well, which shows economy and budget hotel demand down about 5% in the past year compared to the highest three chain scales growing mid-single digits. There's more leisure in the economy segment and more group and business in the higher, so that's part of it, but I thought this was representative. Secondly, the amount of people working from the office is roughly around 50% of 2019 levels. I think this is surprisingly steady relative to, at least to what I expected. An interesting survey recently was a company that ran a survey of about 250 HR managers across different size organizations, and they asked, if you're in the office, how often? They asked that in the spring of this 23 and the fall of 23. The response is roughly centered around 2 and 3 days. There's a clear shift from 2 to 3 days, but that looks like it's the new normal. And we consider how tight the labor pool is, unemployment's low, we talked about that there's more power in the hands of the employment seeker. This seems likely to continue. So I think the result of that could either be a continuation of blended trip travel, or higher occupancies on kind of non-peak days like Thursday and Sunday. Third, we're in a presidential election year in the US. We will leave all politics aside, but the data suggests that US RevPAR growth and consumer confidence broadly in election years show stronger trends relative to non-election years. And lastly is US inbound versus outbound. The yellow dots show the comparison to 2019. International inbound to the US is about 15% below still, whereas Americans leaving the US is up to the tune of 10 to 20% versus 19. So when we think about 2024 and where this is likely to head, international inbound seems likely to improve. We'll probably get more China, more Japan, more Europe. Some will have to do with what the US dollar does. And then on the flip side, we have 2 wars going on across the sea, election going on, pen up to Italy that you and your whole cul-de-sac took this year may not happen as much, and that could represent a change. Looking at that specifically by region, Asia is about 70% recovered. This is inbound to the US, and Europe about 95% recovered. So wrapping it up, spend continues to shift towards experience versus goods, which is a good near-term recipe for travel demand. Flexible work trends are likely to continue, thus blurring the lines between business and leisure, and potentially leading consumers to want solutions or amenities to help serve multiple trip purposes, in addition to including their upgrade in the receipt. International inbound demand can serve as a strong benefit to 2024 travel demand in the US, and election years are typically a good thing for the industry. So where are we going to head in 2024? Few more slides. The first theme, I think, the airline industry is forecasted to bring more travelers in 24. IATA forecast is for North American passenger traffic to be up about 6% this year, improving from roughly 3% above 19 levels in 23. Where are we now for the lodging industry? Our latest work suggests fourth quarter RevPAR growth was slightly below expectations, driven by leisure and large corporate continuing to misplan, while group and small and medium business continue to be exceeding. This seems likely to carry into the year. For 2024 overall, our work points to Q1 and full year budgets that are roughly stable versus 30 days ago in light of that softer fourth quarter, with budgets currently indicating a 3 to 4% RevPAR growth expectation on slight demand growth and 2 to 3 points of ADR. Group remains a bright spot within this overall. As I mentioned earlier, it's back to 19 levels in October. Social and leisure really led the recovery. And then this year, events, meetings, small meetings in particular, and convention demand really picked up. As we looked at earlier, we're in the office less. There's still a need to build culture, build relationships, do training. So there's arguably been group demand created that did not exist before. And looking into 2024, pace sounds strong, up 10 to 15%. With high single-digit room night growth, and we continue to see kind of an elongating group booking window, which has led to this. I think that'll likely ease a bit through the year and probably overall grow 3 to 4%. On corporate, large corporate accounts continue to underperform expectations in our survey work. Some of it seems like it's probably permanently impaired. Think about consulting or financial services. And as a result of that, we see more hotel groups, airline groups, kind of building tools and services to cater to the SMB kind of corporate travel segment, which we believe is about 20% more already than 19 levels. And where that heads for the year, our latest survey work suggests a few percentage point growth year over year in 2024. In addition to that, it looks like price growth on the negotiated side can be up low to mid-single digits. Leisure, I think we discussed in detail, expected to kind of potentially bottom out in Q1 and show growth from there. And then ADR, roughly 18% above 19 levels. Currently, here's our survey work on forecast for 2024 suggests around 2 to 3% growth, which is basically in line with inflation. I am up on time, so I will close these up. But in conclusion, demand in the second half of 23 was mixed. It might be a taste of the new normal. The trend line for 24 in terms of demand segment is likely to carry into 2024 and revert back to historical levels. Things look very mixed by demand segment. The industry numbers do not tell the story and probably are not going to tell the story for your individual market or your business in 24. And travel remains a strong secular grower. So this concludes my prepared remarks. This is my contact info. Would love to stay connected offline, and I am now going to hand off the stage.
Hello everyone, it's great to be here. My name is Resco, and I am the Director of Hotel Intelligence for the Americas at HotStats. And so what I want to do is share with you some insights into revenue, expenses, and profitability, which is what we track globally. So just wanted to start with a quote that we love to use in our presentations, that is that without data, you're just another person with an opinion. And the idea today is to provide you with data so you can make decisions that are based on things other than hunches, which have been reigning over our industry for a long while, and particularly before COVID, while we created our budgets. So let's take a look at some data. First, who is HotStats and where that data comes from? We're a global profit and loss benchmarking company. We receive data every month of the full P&Ls of more than 11,000 hotels worldwide. This translates into 790 companies. These are brands, owners, operators, asset managers that share these P&Ls. We provide data on 160 countries, and the information is released as more than 500 key performance indicators. This covers all revenue streams, expenses, all the way to gross operating profit. So how our data is used? Well, asset managers, consultants, even operators that want to understand their performance versus the wider market. And we offer 3 products with this data. First, internal benchmarking, understanding the performance of each of your hotels within the portfolio. External benchmarking, understanding your hotels versus their competitors. And then market reporting, seeing the profitability profile of different markets. So let's start with the data. I want to begin with a view from the top. This is the 12-month moving average for total revenue per available room for different regions in the world. So we can see 2 distinct patterns here. The first, the Americas in pink and Europe in orange. These are markets that through 2023, particularly after the first quarter, have stabilized their TRevPAR levels. They are stabilizing above January 2020, which was the 12-month moving average of the 2019 months. But still, they were pretty flat during 2023. Then we can see the Middle East, which had incredible growth from $176.37 in January 2020, all the way through November 2023 to $121. And that seems to be a growing trend that continues or just barely started to normalize. And then when we look at APAC, we can see how depressed that TRevPAR was during most of 2022. 2023, with the openings in the region, starts to move back up, and that continues in a growing trend. And how does this translate into gross operating profit per available room? Well, we can see that the stabilization in revenue in the United States led to a start of a decrease of gross operating profit per available room. So even though we haven't seen a decrease in TRevPAR yet, we are seeing that the profit that we get from that revenue is slightly decreasing. So there's a problem in flow through there. There's inflation and labor costs particularly that are eating away at that revenue that we're generating. Now, when we look at Europe, hasn't started to decline yet, but is very much on a stabilization pattern around that $74. And then Middle East and APAC, just like we saw with revenue, still on that growing trend. Now we want to understand better what's the relationship between the revenue we generate and how we convert it into profitability. So what we're tracking here are two dimensions. The first one is the change in total revenue per available room in the horizontal axis. And then in the vertical axis, we're measuring the change in profit margins. So every city or every market that's to the right of 0 has greater TRevPAR in 2023 than they did in 2019. And every city or market above 0 has greater profit margin than in 2019. So this gives us pretty clear scenarios. I want to start with the cities that are in orange on the bottom left quadrant. So these are cities that have lower TRevPAR and lower profit margin than they did in 2019. It's interesting to see because we picked specifically cities to understand how they were performing or coming back. Cities were the last to pick up versus leisure that was really growing much faster and much earlier. So it's very interesting to see that most of the cities in the sample are in this quadrant. But, an extreme example is San Francisco, very much on the low end, very, very relegated in terms of profit generation and the increase in TRevPAR. Now, when we move one quarter up, we have the cities or markets that have a lower TRevPAR, but have managed to get a higher profit margin. So it means they're generating lower revenue, but they're converting more of it into profit than they did in 2019. So that's very interesting to see the Northeast and New York City there. When we move one quadrant to the right, we have the cities that are ahead of 2019, both in terms of profit margin and total revenue generation. We can see Miami all the way there to the right as an extreme example because it really used that pent-up leisure demand, and that helped it increase in both terms. And then when we move one quadrant low, we have the markets that have greater TRevPAR but lower profit margins, so they are experiencing increases in costs that are eroding that profitability. So we have here our two extreme examples. This is the same graph, but we're comparing against 2022. So what we can see is all the cities have greater TRevPAR than they did in 2019, which is great because it symbolizes or it shows that cities are picking up in 2023 versus 2022. But when we look at our extremes, we have San Francisco very much moved to the right, still lower in terms of profit margin, but really showing an increase in revenue year over year, whereas Miami has the lowest increase. So it means this is a maturing city. As was mentioned in previous presentations, leisure has really moved to other places as well, with the opening up of the world and the strength of the dollar. Many leisure travelers went to Europe, went to South America, the Caribbean, and that explains why Miami is relegated as well. Now, when we're looking at revenue, there are many different revenue streams that we can take a look at, and this is an index to 2019 for every month of rooms, F&B, conference and banqueting, other and TRevPAR. So total revenue is pegged very much with rooms and F&B in the recovery, but I want to show you the darkest line, which is C&B. Conference and banqueting, really in 2022, started to recover, but it's 2023 where we see it hover around the 2019 levels. So that means that conferences, groups are coming back, and that's great news. It's actually, in 2023, the one that did the most recovery of all. When we segment the rooms revenue and start to look at it, what's groups, what's transient, and what's contract, we can see that from 2022, which was highly prevalent in terms of transient, groups are starting to normalize back to 2019 levels. And when we look at the rates, we have the contract, group, and transient. It's interesting to see how they differ in evolution. The orange lines, or bars, sorry, are 2023 ADRs by segment versus 2019. The blue bars are versus 2022. So we can see contract is still behind in terms of ADR from 2019, but it was the one that achieved the greatest growth versus 2022. So this shows how hotels are striving to renegotiate those contracts and really looking at growing those ADRs that were left mute at the beginning of the pandemic. Sorry. Now, when we zoom in into what's transient and what's group, we can see that retail and discount for 2023 started to soften. And on the flip side, we have groups. Corporate groups and conventions really started to come back again. So kind of replacing some of that leisure demand that is softening. And when we look at different regions in the United States, this behavior is not homogeneous. So we have the South and the Midwest, which are more diversified, more participation of groups, whereas the West and Northeast predominantly transient. And when we look at the recovery of RevPAR for these regions as well, we can see that the Northeast and the Midwest in 2019 really saw the biggest increase, and this is due to the comeback of the cities like Chicago, New York, and the business travel that went to those. But it's not only rooms. Our hotels have costs for every single square foot. We need to generate revenue for every single square foot. So with the comeback of the groups, we can see conference and banqueting revenue also picking up. So we have food, beverage, and function room rental per square foot for conference and banqueting specifically. And across most of these markets, we can see it increase, particularly for total US as well in all three items. And when we look at more ancillary revenue as well, we see cancellation fees decrease year over year. This is because of a normalization of travel. And then we can see how outlets, parking, and golf have increased as well since last year. But more importantly, we see ADR pick up on a year-over-year basis, but total spend, total revenue per occupied room, also had an interesting pickup of almost 4%. So it's very important when we are analyzing how we distribute our hotel rooms, how much they're going to spend in our hotel, how many ancillary services our guests are going to use. When we look at rooms expenses particularly, we have the top 10 items, rooms expense as a percentage of rooms revenue. And it's a surprise to no one that most of these items are payroll-related items. But number 2 is commissions and reservations fees. It takes 3.3% of the revenue we generate in rooms away. And when we look at the different brand scales, this is not split evenly. We see in the extremes, the actual extremes. Ultra luxury, 4.7%, mid-scale and economy on the low end with 2.4%, and then everything in the middle hovering around that 3% line. And when we subdivide those rooms' cost of sales expenses, we see the transient commissions, group commissions, and reservation fees for the total US on the far left, more or less split up evenly as the groups recovered. But for upper upscale, which is geared towards those corporate groups and conventions, actually overpowering what is the transient commissions. And then for upper mid-scale, we have the reservations fees, which is your GDS or the central reservation systems from the brands, also being on the highest level across all of the brand scales. Now, what we're looking at here is the recovery of those commissions, transient group and reservations fees. Reservations fees was pretty stable even through the pandemic, but what we can see is how groups commissions really picked up on 2023, obviously given that increase in groups group's revenue as well, and they're all now above 2019 levels. So that, again, creating more pressure and more erosion, of the room's revenue that we're generating. Looking further down the P&L, because it's not only about the cost of commissions and reservations fees, we're looking at the undistributed expenses at the hotel. So these are the departments that don't generate any revenue directly, but they are there to support the operation of the full asset. 25% of all the revenue that comes into the hotel leaves the hotel to account for these expenses. And out of these, sales and marketing is tied up with admin and general as the biggest expense at 8%. Then we have property and maintenance, then utilities, and finally our IT systems. And when we look at these sales and marketing expenses, we can see that's really for the upscale and upper mid-scale that are leading the pack. Upper mid-scale going to 12.9% of their total revenue that's used to pay for sales and marketing expenses. When we break down further these sales and marketing expenses by item, we have at the further left the increase in total revenue versus 2022 in orange and versus 2019 in blue. And that is to have it as a comparison to how much expenses really grew. We can see that all of the expense lines are higher in 2023 than they were in 2022 at a higher rate than the increase in total revenue. So as revenue increased 10%, we have all of the expense items in sales and marketing increasing more than that. So again, we are using a greater part of the revenue that we are generating to account for these expenses, and they are increasingly putting pressure on the bottom line. So we have loyalty programs, franchise and affiliation fees. I want to bring your attention to other expenses. So this is photography, website collaterals. This is the creation of that marketing material that we heard about. It's interesting to see that pick up 17% year over year, because some of the PIPs have gone through. The hotels have been renovated. They don't look like what they looked in 2020 or 2019. So it's interesting to see how we are updating that information. And as more PIPs and more renovations and flag changes actually are finished in 2024, we expect this pickup to be even higher. When we look at loyalty programs and franchise and affiliation fees, they are even higher than they were in 2019. So even though total sales and marketing expenses are at the same level or close to the same level as they were in 2019, these two items are actually much greater. Now we're looking at the staffing challenge. So what's payroll like in sales and marketing as well? Remember, we had the 10% increase in total revenue year over year. Total labor costs increase around 13% as well. So again, another item that's growing at a higher pace than the revenue that we're generating. I want to look at sales and marketing non-management versus contracted labor, because it's an interesting opposite direction. Versus 2022, we see that this item has increased the non-management salaries and wages, whereas contracted labor decreased. Now, what's happening is it's very hard to source employees to staff our hotels. There's a lot of competition, and employment is very low despite the higher interest rates. So what hotels are doing is pivoting to third parties, trying to source those employees that they cannot find or hire themselves, so source through third parties. As we see the increase in non-management salaries and wages and the recomposition of this department, we start to see contracted labor go down. But still, from comparing to 2019, contracted labor is much higher than it was, whereas non-management salaries and wages is still a bit lower. So there's still more to do in sourcing and rebuilding the teams. Now going back to profit margins. So we talked about how when we're looking at the 12-month moving average of total revenue, we see a stabilization and very small growth in the US in 2023. We did see that expenses are growing at a higher pace than revenue, and that means that GOP part started to come down like we saw in the first graphs. When we look at the margins for the brand scales, we can see that versus 2022, across all the segments of the brand scale, there was a compression. and a decrease in profit margins. So how much we convert of the total revenue. And it's in the extremes again where we find that discrepancy to be the highest. So ultra luxury and mid-scale and economy. And for ultra luxury and even luxury hotels, really 2022 was a very high bar. So even though we see a decrease in that profitability, it was expected to happen. In 2022, we had great rate growth, but also we had more of a captive market, whereas in 2023, we did see that international travel, outbound travel from the United States increase, but not so much a return from the rest of the world to the United States. So that's really what's behind these changes, as well as the coming back of the norm of the service standards we provide. And so key takeaways from the data. First, that total revenue stabilized around a little higher than 2019 levels, but we don't expect great growth for 2024. We do see corporate and conventions, corporate groups, and conventions coming back stronger in 2024 as well. The transient commissions, group commissions, and reservations fees, again, stabilizing a little higher than they were in 2019. And a very strong labor market that is going to still put pressure on our margins through increased labor costs. So a combination of this slowly growing top line with the pressures of inflation and labor costs, we do expect to see more pressure on the margins and a further contraction of margins. So this is me. Let's talk. I'd love to share this presentation with you. If you have any questions about markets that were not covered, because it was a very small sample, please let me know, and I'm happy to talk to you.
All right. Thank you. That was a lot. I'm sure you guys have tons of questions. I know I have a few. We're going to have some people walking around with microphones if you have any questions, but I'm going to throw one out first because I'm really curious about this. So there's been multiple speakers today, including both of you, talking about groups and how groups are growing. Do you have any indications what types of groups are those? Are those the big groups? Are they, corporate? What is driving that?
So I'll take it first. So for us, a real change that we saw in the data is for corporate groups. But these corporate groups that are meetings and get together, a team that is hybrid or that is remote, and just being able to share, and you talked about this in your presentation as well, sharing the culture, the strategy, and where we're going. So that was a big change for us. But we do see big conventions coming up as well that are booked through 2024. So I think it's a combination of everything. The smaller corporate group that is there just to share with all their employees and to be part of the big company, even though you're hybrid or remote, and then these big blockbuster international conferences as well.
And are you seeing the same?
Yeah, I would agree with those trends. Just, I guess, to add a little bit of recent data points to it, if you kind of look over the last 90 days, in terms of breaking down groups by size, so you look at less than 50 or 250 to 100, 100 to 250. Really, what grew quickest and recovered kind of the fastest was those smaller groups, as was just mentioned. And now what's showing the bigger year-on-year growth rates is those 500 to 750 person groups, or the 750 plus, the big convention and association type meetings, things that take further to plan, and yeah. So I think is primarily what's driving the growth into 2024. When you look at kind of what's on the books that's higher than it was the same time last year. Because those smaller groups, I'm sure a lot of people in the room have seen, are booking shorter term and much closer in, probably a lot within a 60 day window, more so than they used to.
Anybody have any questions in the audience? No?
I'm curious about the longer term. So it's very useful to hear all the information about the next year or the upcoming year, but do you have any information? Thanks. I'll just repeat my question for everyone. It's been great to see the sort of forecast for the upcoming year, but I'm curious about sort of the longer term, particularly growth in overall hospitality demand. So I don't know if you have any information you can share about, say, a 5-year horizon. Thanks.
Well, the first thing I'd say is my assumption on industry growth 5 years from now is probably looks the same as anyone else's, in the case that it's most likely wrong. But what we can do, I think, is look back at historical growth rates over an extended period of time. Really, the only data point we have, or industry to do that on, is the hotel industry, where demand typically grows over a 30-year period, roughly 2% a year. And it kind of seems like that is kind of things are in place to get back to historical growth rates. When we look at the other kind of sectors of accommodations, the vacation rental category or short-term rental has slowed down from growing 15+% back pre-COVID years to now being in probably more like a mid to high single-digit range, and yeah, I think that's how I'd frame up the accommodations space. If you look at some of the airline data, all of the airline industry forecasts for capacity growth, looking out the next year, the next 2 years, if you rewind a year or two ago, have been pared back. There's been issues with pilot shortages, materials delays from OEMs, and all sorts of engines and parts. And so I think there are constraints to driving domestic, like air travel demand, but yeah, that's how I'd frame up a couple of the areas.
So my accent may not have shown it, but I'm not from here, from the US. I'm from a country called Argentina, and it's a very cyclical country, right? We're always living today thinking what past situation we're going to be living tomorrow, what iteration of the past we're going to be living tomorrow. So we have a saying that goes, we still have a lot of past ahead of us. And I think that's kind of the theme, right? We've been looking at when is 2019 going to come back. I guess right now we are almost there. We're seeing patterns start to normalize again. We're not seeing those just completely off the chart changes, so mega increases in ADR and just, either up or down because, the decreases that we faced and then during 2020. So I think we're normalizing our patterns again. So now we're living that path that we were trying to get to. So I agree with you that I don't think we're going to see very big swings, but rather a stabilization and normalization for the coming years. Though we do have wildcards, right? In the US, we have the election, which is kind of reliving the past, I guess, again, because it looks like we will have the same two candidates as we did in the prior election. And then we do have the geopolitical instability. So what's going to happen with the supply chain, international travel? Those are things to think about, but I don't have any answer to that. But I do think we will normalize.
Question over here? Up in front here.
Hi there. Really, really great presentation, both of you. Something that really struck out for me was that on the inbound, outbound travel, there's a huge bias now in favor of outbound travel from the US, probably because, striking back to my revenue management days in the airlines, there's, US-based passengers are much more high yield, right? So the revenue management systems will favor US passengers. You know, there's capacity constraints, as we talked about. So, you know, we can't really have both high inbound and outbound. You've got to have one or the other with the capacity constraints that we have across the global airline network at the moment from the US. And then if you add the high price of inbound tourism into the US, you know, with the strong dollar, with the high average price of hotel rooms, how much of a risk do you think that presents to the US, you know, hotel industry? And what can the US hotel industry, what can the US tourism industry do to promote more inbound tourism?
That's a great question. Well, the strength of the dollar definitely played a part. Also, I think there was a pent-up demand of seeing something else and going out in the world, because for the previous years, that was very difficult. The world hadn't opened up. So I think that feeds into it, as well as the strength of the dollar. Let's see what happens with the interest rates, right? The Fed said they were planning on lowering the rates, particularly the second half of 2024. So that may impact as well the strength of the dollar and soften it and make it more attractive for international travelers to come to the United States. As for what the US can do, there was a very interesting report that came out recently that said that the US wasn't exactly friendly to travelers outside of international travelers because visa constraints. There wasn't a lot of promotion of the destination as some other destinations are doing. So probably there's also an answer there. If we make it more difficult for international travelers to come here, if we don't process their visas in a shorter time frame, then of course they're going to pick other destinations. So I think that would play a part as well in this.
I add a couple things. If you look at least as of a couple months ago, the major airline carrier forecasts kind of by region for next year. Think about United or Delta or American. I'll use United as an example. And last year, their transatlantic capacity was 30% above 2019 levels, probably for a lot of reasons to your point about the higher yields. Well, the domestic flights flown capacity was still a little bit negative. And when they've discussed their plans for 2023, it's basically, okay, here we added all this capacity to Europe. Maybe we'll change some spots around to send demand to more higher demand locations within the region or within the Middle East. But that's basically going to remain. We'll add as will domestic, and what will grow is to APAC. The other airlines have said the same thing. I'm not as familiar with the schedules coming into the U.S., but that would probably be a good thing to look at. And then I know there's been good success in driving both European demand into China. As China reopened, they changed some of the policies around leisure transient stays for up to 14 days for a handful of European states, and it sounded like that drove a big influx of demand into the region. On the flip side, there's been some changed visa policies between China and places like, I don't want to name the wrong countries. So I'll say a couple of countries in Asia that has driven strong outbound from China over like the upcoming Chinese New Year. So I think maybe using that as an example, it may be worth reaching out or discussing with kind of representatives of that type of partnership from your local DMO or tourism heads and the place where you have most of the business.
Hi. Last week I spoke to some big airlines. They were mentioning that things have changed as far as destinations, that they're opening or either they're chartering and then they're opening new routes or new destinations based on corporate demands, some new types of companies, certain industries, but also the leisure, to your point. There's been some shifts in some cities. You show a lot of the primary cities, but have you identified secondary or tertiary cities where there is a huge difference in demand since 2019?
We focused that particular study on major cities because it was the question we were trying to solve. So where are cities, how they're trending, when does the comeback start? But I'd be happy to have a separate conversation. Maybe we can talk about later if you have some specific markets in mind or if you're just looking for secondary. Okay.
Hi, could you share any booking window insights into the transient segment? We know that the group booking window has kind of increased as we're seeing more groups coming in. But do you have anything you could share on the transient segment?
Well, we don't track that information at HotStats. So this is just a general overview of what we're seeing in other data points, like cancellations. They're down more than 30%. Well, that tends to signal that the booking window is shorter, and so you don't cancel as much, right? You don't have to make such long-term plans and then see whether you can make it or not. So for us, through the different data points, it looks like that booking window is becoming shorter. But again, that's not specific data booking windows that we track.
If Katie is still in here, she had a QR code up there earlier, the link to which will take you to something that I'm sure will include that data in great detail.
Thank you for the two good presentations. There was only limited mention made of short-term rental, and it's become, in my estimation, a big deal in the lodging marketplace. We tend in the hotel business to equate hotels to lodging, but there is this other segment. Do you have any thoughts on where short-term rental is going over the next several years? You gave one indication that it was growing faster than hotels. It has to have some outlook. It has to have some impact on us. Can you give us any thoughts on STR?
So we go to all the hotel industry developer conferences as well. And if I think back, one of the biggest ones, NYU, and the discussion around Airbnb and Vrbo over the years, it went from something like in 2016, oh, who were they, to 2017, it's taking some ADR compression away on high demand events, to now they're driving supply up, to now they're causing housing crisis, affordability, to now we're competing with them for transient demand. So it's, I think it's clear that the attention, and then you've seen hotel companies move into the industry in various ways. Obviously, it's not a core piece of the business, but it's been given attention enough and viewed as a competitive set of where leisure travelers spend their dollars. What we looked at earlier, like you mentioned, was the year-on-year growth rates. I think it's also helpful to just frame up like share of demand, because I think its short-term rental has gone from something like, I don't know, 12% to 14%, right, of like industry demand. You compare that to hotels, and looking forward, I think the outlook is that probably continues to gain a little bit of continued market share of the leisure travel segment over time, just as more consumers discovered that as an option over the past few years. But the good thing for the hotel industry is that they've got group and business transient as demand growth drivers that are less of a kind of competitive overlap with that space.
Great. Thanks, everybody, for the really great questions. Thank you, Matt. Thank you, Laura, for sharing your information with us. If anybody else has any questions, grab them over a drink. I'm sure they'll give you lots of false information. I don't know. Make stuff up. I don't know. But thank you.
Thank you.